Chris Preston,
I'm Brad Simmerman.
and welcome to Street Check, the best two-person podcast in the history of Cabot Wealth Network. Lots to get to, Brad, today. Before we hit the 4th of July holiday shortened week. But first, we have to talk about the elephant in the room, and that is the most street checky moment in the history of this podcast, at least non-investment related. As some people may vaguely be aware, this is Street Check is sort of a play on sort of
Heat check.
what's that?
Heat
Yeah, a
check.
play on words on heat check, which is a basketball term, which some people may not know or may not know. We occasionally touch on our love of basketball and our teams. Your team, the Phoenix Suns, you live in Arizona, just drafted a player in the NBA draft from my team, University of Virginia basketball, Ryan Dunn. What are your thoughts on the pick?
I'm good with it. He's got a lot of miles on the tires. He'll eat up minutes while our superstars don't score. And then 2 years from now, we'll trade him for the corpse of a different superstars, and he'll really explode. I heard a lot of comparisons to Bridges, who was my boy for years. You know, my son's jersey is Bridges. Loved him to death. Still love him. Glad he's doing well. I think you're going to get a similar outcome with him. He's going to go somewhere else and just blossom when he has. Although the 25% from beyond the arc shooting,
Yeah, no, I'll say
maybe not.
he could be Mikal Bridges minus the offense. Like I said, he'll probably average like 2 points a game for his career, but might be matched up against, LeBron, Kawhi, Luka.
Yeah, great.
Yeah.
Throw
Yeah.
young bodies in front of them instead of Booker, who's already carrying so much of the offense. I did hear Matisse Thybulle thrown around as
Yeah, that's a good
a
help.
decent comp for him. So yeah, if he turns into that in a year, great. If he turns into it in 2 years, we won't enjoy it because he'll be somewhere else when we dump Bradley Beal's albatross contract on somebody and they have to eat 50 mil a year.
Wow,
I think he,
you're really a jaded Suns fan.
we,
But that's probably enough Suns and UVA basketball talk. Okay, tell people what we're going to talk about that's investment related today.
So we are going to talk about rotation. Are we seeing investors move away from the AI theme, profit taking in Nvidia, stuff like that? Buffett betting big on oil, or continuing to bet big on oil. Is that maybe bullish intermediate term? And then we're going to talk about Walgreens, who had a pretty disastrous earnings report, and that's pretty well reflected in the share price as well. After that, we are going to each make three calls for the balance of the year. So 3 years, three predictions apiece for the end of 2024. Before that, this time, Chris, you are on deck to defend a take. Your take, no recession this year. You have 90 seconds. You may begin.
Yeah, actually, no recession in the next year. So pull up the data on probabilities of recession. So there's a 52% probability of recession by end of next May. So 11 months, basically. That's up slightly from 50% at the end of April. This was a month ago. It always projects like about a year out. And the probabilities of a recession have been above 50% since the end of 2022. And the long-term average of a recession in the coming year is 14.8%. So this is really sort of unprecedented. No, I shouldn't say unprecedented, but this is rare. The chances in, June 2022 were a mere 5.9%. That jumped to 17.6%, then 25, all coinciding with when inflation just exploded. And by the end of 2022, it was up above 50%. It stayed there ever since. So for a year and a half. And there has not been a recession, and there's no recession really in sight. Now, GDP growth has slowed, that's true, but earnings growth is not. And I think the Fed is going to act now in a way that, by cutting rates, that is going to cut off the probability of a recession, and we're going to get the
All
soft
right.
landing that was promised.
Okay, there we go. Soft landing, called here. We are getting it. Um, as much as my natural instinct is to totally disagree with you, I think we'll learn later. I don't know, man. I don't know. I think you might be right on this one. And if we're both agreeing on it, that's probably bad news for the economy.
Right.
But
Yeah. And I mean, it's sort of it's a little bit of a just a, too many times crying wolf situation, but it's also, I think, I
so,
think the numbers have been bad enough. We're in a weird place where the numbers have been bad enough with GDP growth shrinking to, what was it, 1.3%? No,
yeah,
yeah, 1.3% in the last quarter, and projected, I think, just 0.6% in Q2. We'll know in a few weeks. Or maybe a week. But but then also earnings growth was like 6% or more, and um, then meanwhile inflation has come down. A PCE gauge this morning was its lowest reading in 3 years. So we've sort of reached the sweet spot where inflation um, is low enough where they can rationalize cutting rates, and also the economy isn't on fire enough. It's sort of consolidated enough that they can also rationalize cutting rates.
yeah. There was something that Bruce Kaiser, former Cabot analyst, wrote about uh, being in a sort of an inventory cycle or a rolling recession where different segments of the
Yeah.
economy are getting hit at different times. Which, if you're in the segment that's getting hit is not great because it feels like a recession to you, but you look around, it doesn't feel like a recession anywhere else.
Right.
But in the aggregate for the economy, it allows the economy as a whole to avoid what would classically be defined as a recession. Um, and I don't know, intermittent pain in different sectors that sort of cycles through over a multi-year period sounds like a pretty good outcome coming out of
Yeah.
a post-COVID supply chain crunch world with the, the quickest hike in interest rates in decades. Like if the outcome of that is we get periodic weakness in other sectors, that seems like a pretty good outcome to me.
Yeah. It's almost like a recessionary or economic version of U.S. economy version of sector rotation, you
Yeah.
know? Um, which, yeah, I agree with Bruce's take there. If you're in certain areas of the economy, there's a reason why more than half Americans, at least as of the latest poll in May, thinks we're in recession now. We're not. I mean, we haven't been close. It's because some people, some of that is misinformation, social media and whatnot, but also it's how people feel, and some
Yeah.
people,
The vibe session.
yeah, right. So anyway, we're in agreement there. Okay, let's move on to our big three. Number one, Nvidia is down about 6.5% in the last 10 days after hitting all-time highs. It's come up. It was worse. It was down what, like 15%?
15% from intraday highs, something like that. Yeah.
Yeah. So it's gotten better. In the meantime, the Dow, which has lagged lately, is up. It's been the best performing index of the big three in the last 10 days. Equal weight index flat. But Russell 2000, which is the biggest underperformer. This is small cap stocks, up also about 1.3% last 10 days. This is while Nvidia's pulled back 6.5%. Has Speaking of rotation, has the rotation to non-AI sectors, non-Mag 7 stocks begun, or is it too early to make that call?
My my estimation is that smart money is rotating. Um, but this is so today happens to be June 28th. It's the last day of the second quarter. So you have a lot of window dressing going on right now where funds are buying up stuff to show that they have exposure to it and maybe imply that they've had exposure to it for longer than just the last day of the quarter. Nvidia up right now 1.25%. Today it was as high as 127.63, so it was up more than 3%
Yeah.
earlier in the day. My takeaway from that is I think that there is still a desire to show retail that you are invested in these hot tech stocks, even if on your own, within your own portfolio, within your own balance sheet, you are maybe profit taking. But it's consistent with, like we've talked about, people not running for the exits, right? You and I don't think people should be selling Nvidia wholesale to jump into something else. It's run up too much. There's still the sort of AI narrative around it. Nobody exactly knows how that's going to play out. Um,
Right.
so maybe it's more accurate to call it smart money profit taking than rotation. But I think in it from a practical standpoint, it's got the same effect. But yeah, I think we're seeing some rotation, but I don't think it's wholesale. And I think
Yeah. It almost seems like the market's sort of deciding where it wants to go. And we sort of, and I'll get into this more later. Summer malaise is pretty normal and especially normal ahead of an election. So it's possible we may not get a definitive direction until after the election or until if the Fed were to cut rates,
yeah.
start cutting rates in September, or before, which is a small percentage chance of that. But yeah, I think we could, even in the interim, if there's no definitive direction, I think that it could almost amount to a rotation in just that money isn't pouring into the same, what,
But
15 stocks. I mean, Mag
three
7
stuff,
plus.
right? Like
Well,
at this point,
yeah.
it feels like it's like one or two or three. But yes, I
Well,
get what you mean.
NVIDIA has some like coattail riders like Supermicro Computer and
Yeah,
what, like that.
Micron.
Yeah, Palantir, maybe. Yeah,
Yeah, everybody in the data center,
yeah,
everybody in the data center game, where they're anticipated to be beneficiaries of that same kind of build out, even to some degree. Energy and like nuclear power is another
yep,
one that has gotten a lot of attention lately because hey, if I can buid a small modular reactor that powers a data center
yep,
and just drop it right next to my data center, that's way better for my long-term costs than like building out infrastructure to get to whatever the primary power supply is for the area that I'm in, and then my ongoing power costs. Bill Gates has been investing a lot in nuclear energy lately. It's sort of a net green initiative, despite it getting a lot of, um, having a lot of bad. I don't know the word I'm looking for right now, but it's got a lot of negatives associated with it. Carl Delfeld of Cabot Explorer has been a big advocate for nuclear energy as a means of like depowering Russia. But that's one area that I was looking at that I think has a lot of promise to it. That also happens to coincide with that AI narrative you were talking about.
right. Um, yeah, so we'll sort of wait and see, but obviously hard to bet against Nvidia and all these, Mag 7 type stocks, AI, but it feels like the air's coming out of the balloon a little bit right now, but we'll have to wait and see what happens in the next few weeks. Um, Shifting gears to number two in our big three, as you mentioned, Warren Buffett. This isn't anything new, but it's continued to bet big on oil. Another $435 million poured into Occidental Petroleum, OXY ticker symbol. It's now his sixth largest position in the Berkshire Hathaway portfolio. This isn't, necessarily an investment recommendation, but the timing, with energy, oil prices have been down. They're back above $80 a barrel now, up from, I think they dipped as low as what, like 73, 72,
Yeah, like
73
low
last month.
70s.
So there's a little bit of momentum there, and maybe that's just what he's tapping into. Does him sort of, putting up this amount of money on his favorite oil stock now, or at least one of them, that make you more inclined to invest in energy over at least at the short to intermediate term?
Um, I don't know. Oil's a tough one. Oil
Yeah,
is
I'm
one that
not a
I
big energy guy myself, but I guess just um, from a momentum
it's
standpoint, I wonder if this could be the first domino to, say in a couple months from now when the market's sort of in a pre-election slog, and in Mike Santillo's Cabot top 10 trader issue, which is 10 of the top momentum stocks every week. I wonder if like half of them will be in the energy space.
Yeah, I mean, maybe like that. So if we are seeing this sort of rotation, this inventory cycle, this sort of economic rotation, energy could certainly be the next beneficiary. My inclination to play it would probably be looking at something that has more of an emphasis on renewables, or something that is entirely
Yeah.
domestic oil production versus something that has maybe a more global footprint. Like even if I'm losing alpha, or if I'm losing like potential upside returns because their operations are better. I know the US has drawn down petroleum reserves a lot, so there's an impetus to buy there. Russia and Russian oil production is problematic because of the situation in Ukraine. There's been threats to switch to like a brick currency or to de-dollarize assets. That would also make me more inclined to look at a pure US play. But yeah, I mean, I don't think Buffett is doing much different than looking for upside opportunities outside of where he has already made a lot of money. I mean, he made a fortune in Apple. He downsized that position after tech ran up a lot, and he's looking to diversify the exposure elsewhere. I think, from a broad picture standpoint, that's a fundamentally sound strategy. I'm not going to bet against Buffett, but is oil the
Right.
next one? Maybe.
Yeah.
It doesn't seem to be anything that's consumer driven now, given what we've seen on with consumer spending, especially as it impacts retail, fast food. I mean, we saw Nike's results last night. They're down like 16% today. Um, People are feeling a little bit pinched, and insurance, energy, that kind of stuff that's in the Berkshire portfolio is pretty insulated from a weaker consumer. I mean, maybe that's the answer. You just go out and buy Berk B
Yeah.
instead of buying
Right.
oil companies directly. You're like, okay, well, I'm just going to trust that Buffett's making the right moves here.
Yeah. I mean, value stocks, as we know, have underperformed for quite a while, maybe law of averages finally. But as we've mentioned before, Buffett has some growth, including Apple, and BYD and others, in exposure in his portfolio. So yeah, that might be a good sort of growth and value blended um, portfolio to invest in. And I mean, you can never go too wrong investing or aligning with Warren Buffett. Um, you mentioned retailers struggling. Nike down 16%
Yeah.
after earnings. Well, Walgreens was down even more than that, 20% yesterday, after announcing some store closures. I don't think they said a number yet. I think you said up to maybe 25% of their
My
stores.
my understanding from the conference call and their communications with whatever third party is going to be helping them with the wind down is that they'll be looking at 25% of their somewhere around 8,600 stores. So, maybe they cut 10% or 15 or 20 or 25 or 30, but
Yeah,
closing 2,000 stores out of 8,600 seems to be right about in the middle there.
that's a
So
lot.
it's
And the stock is down now 52% year to date. Uh, is this the next J.C. Penney? Uh, Macy's block. I mean, J.C. Penney is not even a stock anymore. Blockbuster. Like, will this company exist in 5, 10 years?
Yes, I'll say yes, it will exist. I don't know. I don't know if they own any of the property that they're sitting on. Just they're in a lot of, those sort of big retail footprint shopping centers,
Yep.
where it's probably unlikely that they own much in the way of their own real estate. That was something that helped, I believe, helped Macy's a lot when they were facing bankruptcy. But the one of the issues with Walgreens, it had been a dividend aristocrat for a long time. They cut their dividend in February and they got sort of kicked out of the dividend aristocrats list because of that. They lost a lot of money on Walgreens, on Boots UK. That was their UK based convenience store pharmacy chain. Village MD was their attempt to have a sort of an associated doctor's office with the Walgreens locations, and they took. I was looking at their latest earnings. They took a pretty big hit to goodwill based on writing that off.
Yeah.
They're a struggling retailer that for a long time most of their margins were on incidental items. So they're not making a ton of money on prescriptions. They're not making a ton of money on allergy medication. What they're making money on is you stopping and grabbing a birthday card on your way out the door, or you bringing your kids in to pick up a prescription and buying a Gatorade and M&Ms, or if it's the only sort of walkable store in your area, you go and you buy overpriced groceries. Um, I don't think consumers can support that high margin kind of shopping.
Yeah.
If you're looking to save money, which people are doing, seeing it with fast food companies, right? They're cutting their spend there. Um, you're not One of the easiest places to cut is the impulse buys that were a real driver for Walgreens. I wouldn't be surprised if after they downsize their underperforming stores, within the next year or two, they come out and say that they're going to be reviewing additional stores or they're going to be taking on extra cost cutting measures. They've actually, I think the announcement this quarter was that they were going to save $1 billion by closing stores. Well, that's up to a total of, I believe, 4.5 billion in cost cutting measures that they're pursuing, which has grown from like 1.5 billion 3 years ago. So they've been stacking cost cutting measures right now without any sort of positive results to show for it. Like you said, share price is down 50%. They made a lot of bad bets. They're in a bad position in a tighter economy. I would be more surprised. I would not be surprised if more closures are coming after they do this review, or at least some other cost cutting initiatives get tacked on.
Yeah. And I wouldn't call it, I wouldn't say that down 50% year to day is an invitation to try and buy it on the cheap. I think more likely to be down even further a year from now than
No,
than
yeah.
it is now.
One of
Yeah.
the one of the posts that we regularly update on the daily is about the highest paying dividend stocks on various indices. Walgreens was persistently part of that,
Yeah.
and Cliff had written that. I've written parts of it. The sort of consensus had always been like, look, Walgreens has a lot of structural difficulties that do not make it a good uh, bottom fishing pursuit, right? You're better off letting them reestablish a solid business and actually show profitability and improving margins and all that stuff going forward. It's a stay away. Even if you're a value
Yeah.
buyer for now, it's a stay away.
And it's no longer a dividend aristocrat, right? We lost
Yeah,
that status.
yeah, and
Did
that
not happen.
I mean, there's not a ton of money indexed to the dividend aristocrats. There are ETFs, so there is
Right.
some institutional buying there, but
Yep.
if you think about other retail investors that are looking for high dividend paying stocks, they now have less of an incentive to buy Walgreens. So all you've got is, I mean, I think it's trading close to book value right now, but it can trade at less than book value, right?
Yeah.
Like that's,
Plenty of stocks are right
yeah,
now.
exactly.
Yeah. Okay, let's move on to our featured segment for today, which is six second half of 2024 predictions, which are sure to be right. Three from each of us. I'll let you go with your first prediction.
All right. There is I'm trying to get the saying exactly right. There is a saying that the bull market doesn't end until the last bear capitulates.
Hmm.
So take that as your warning. I'm gonna start with, I think, the most bullish take. We will set new highs this year. We will set double-digit new highs this year, meaning we're going to have at least 10 or more trading days that are new all-time highs on the S&P. I was looking at some of the valuation ratios. We talked about the Buffett indicator, I don't know, a month ago or so, but something along those same lines. One of them that I was looking at is the S&P to M2 money supply ratio. It essentially measures how much of the money that's floating around out there is getting funneled into the stock market. It's just the index value divided by M2 money supply in billions. Right now, it's at about 0.25. Zero point 0.2 has historically been about the top. We were in this same sort of range before the '08 crash. We were in the same range at the top in 2021. The all-time high ratio was the 2000-2001 dot-com bubble, where we hit a ratio of 0.3. If if this if we see similar levels, that would imply about a 20% upside to where the market is trading now. We're already in sort of uncharted territory for the last 25 years, going back to that period. I don't, absent Nvidia getting destroyed on earnings, guiding lower, or people coming out, or companies coming out and specifically saying we're abandoning artificial intelligence. I don't know what, or a war, right? Like a black swan event. I don't know what stops this market from going higher and retesting the valuation levels that we saw in 2000, 2001. That's 20% upside. I don't know if it gets to that level, but I think we keep hitting new all-time highs.
Wow, that's one of the more bullish things you've said on here in a while. And
Maybe
amazingly,
ever.
we did not share our respective picks before, so that we could sort of react to them uh, live here. My first prediction is similar. I said stocks will be up between now and the rest of the year, but funny, mine has a little bit more of a bearish twist than yours, but they'll be down between now and the election. That's just, I talked about that a few months ago here, a few weeks ago here, that the pattern is before elections usually starts around August, like mid-August. So may not be a threat yet, although who knows after last night's debate, which we're not touching with the 20-foot pole, that stocks are typically down for the last 3+ months, or I guess last 3 months, give or take, prior to the election, prior to an outcome, and then usually rise after that. So that would start, around maybe mid-August. So I think it'll probably be a similar pattern this time. I would guess, especially, given that we're right around all-time highs now, at least in the headline indexes. I would guess we'd be down between now and the election, but I think we'll rally enough after the election that it will be up for the year from between now and the end of the year. So basically, this is sort of a delayed sell in May, go away situation. I'd say sell in August, go away until, what is the election date? November
2nd or 3rd, right?
Yeah. So until whatever, the day after the election, depending on.
I wonder.
It's the pattern.
I wonder if there's the potential for, right? Like, so a lot of the boost from Biden, at least to the market and economically, is the Inflation Reduction Act, right? So multi-trillion-dollar investment in green tech and clean energy and stuff like that. That's going to take a long time to matriculate through the economic system. I wonder if there's a sort of sweet spot Fed soft landing version where Trump continues to do better in debates than Biden has, or again, not going to jump all over that, but where his odds of maybe winning start to improve, and then Wall Street looks at it and says, well, we've already got all the money coming in from the Biden initiatives. We will have a more favorable business environment under Republican leadership. I wonder if there's maybe a soft landing sweet spot where the market just drifts higher, where,
Yeah.
I don't know.
The wild card this time is, as we talked about, the Fed. If they do start to make cuts in September, which is what people are expecting right now, that could be different from previous lead ups to elections.
Yeah.
It's possible that the first cut may already be somewhat baked in, but I don't
Yeah.
know. We haven't seen it yet. So you know, maybe the timeline is a little different this time. Maybe the sort of the churn or modest pullback is sort of starting now, and the pickup will be once if the Fed cuts rates in September. Um, election be damned, since it's two guys who've already been precedent before.
Yeah. Yeah, and I guess maybe what'll tell the tale is, let's say Fed does start cutting rates. Are institutional investors just continuing to hold the stuff that's been overperforming for the last 10, 10 months now, give or take? And they're committing capital that's been sitting on the sidelines to stuff like small caps, international, um, or are they still happy to take high cash yields and high fixed income yields, and are they rotating money around? Because if they're rotating money around, I think it sort of pins the S&P near levels that we're at now. If they're committing fresh capital, then I think you see some of the laggards start to pick up the slack and drive markets higher.
Yeah, we'll see. Okay, what's your
Uh,
second prediction?
all right. My second prediction, this is one that I've sort of been dancing around a little bit. As much as I think it should, I don't believe the AI narrative ends this year. Um, like I had mentioned earlier, that Nvidia trading higher today, a lot of the window dressing seems to be continuing to focus on AI plays. I don't know if it's being done solely to be at the expense of retail, right? To show people that you're still invested in Nvidia. Michael Brush of Cabot Cannabis Investors shared some bull bear numbers that show that retail investors are still in the fear camp. So we're not hitting that exuberant level. I mean, there's a ton of retail capital already in AI. Um, Toys R Us came out with an ad recently that used a video generating AI tool that was, surprisingly good. I think there's maybe more juice to squeeze here, and especially if retail investors are still apprehensive, we might just climb that wall of worry, and the narrative doesn't go away, barring Nvidia, like I said, just totally missing on earnings at some point. Um, it's like Tim used to say, right? The bull market couldn't go on longer than anybody expects, or the trend can
Yeah.
go on longer than anybody expects. I expected it to be over. I still think it's a little bit misplaced, but uh, AI narrative doesn't end this year.
Yeah, it's a classic. Um, Markets are never wrong, opinions are, kind of a thing,
Yeah,
where everyone thinks, AI narrative is at least at least temporarily run its course. The sort of what is it, the romance phase is over, and now, reality may start to set in. And the reality may be, even though AI by definition is not reality, the reality for AI may, be as good or close to as good as advertised. Um, but we're still sort of in the romance phase. And that, like you said, you know, Tim always talked about how trends last longer than anyone expects. And I doubt the AI theme will completely up and fizzle in the next 6 months. Yeah. So I
yeah.
agree with you, I guess, is what I'm saying.
Okay.
Yeah.
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 I don't know. Maybe it's like, how do you? It's a hockey stick, right? Like, where does the hockey stick of growth end?
Yeah.
You can't practically predict it. Um, I have I still think that we're gonna see maybe at least some lackluster results from the tech, but it's I mean, it like the internet. You had connectivity. You could envision connectivity improvements for everybody.
Hmm.
But with AI, you don't have those same kind of technological constraints on people imagining what it could do. Uh,
Right.
So I wonder if maybe it's got more room to run than the typical hype cycle would predict, where if all the emphasis is on AI and it turns out that large language models are not as effective as people thought, well, the next pivot is, AI generated content, and then there's a pivot after that. Like maybe that's more juice for AI as a narrative. I don't know. We'll see.
Yeah. Yeah, I would expect that there'll be at least some cooling, and I think that's already sort of happening, as we talked about at the top.
Yeah.
Some cooling in the second half of the year on AI, but that doesn't mean cooling doesn't mean over.
Abandonment. Yeah.
Yeah, right. Um, I think we even talked um, a few weeks ago about how, we think that NVIDIA won't have the same second half that it's had in the first half, but you'd still buy it, for the long term, and even for the next year, because still probably get pretty decent return.
What's
Okay,
your number two?
my number two. This is a recycled one, or maybe I'm doubling, tripling down. There'll be two rate cuts, and they will be in September and December. September is, what is it, up to like 2/3 of people think there'll be at
Yeah.
least one rate cut by September. There's even a 10% chance of the first rate cut happening in July, which I don't see that, but I would say it's not completely off the table at this point, especially after PCE came in, as I mentioned, at 3-year lows this morning, like 2.7%. Yeah, I think September will be the first one. I don't think they'll do it in November because it's just too close. The same week as the election. I think they'll want us to stay away from
Yeah.
the impression of being, swayed by the new administration there. And then December will be the second one. We've had a variety of takes on here about rate cuts. Tyler London, who was here, had the hottest take, was on here about a month ago, and he doubled down on this in his issue the other day. He thinks there'll be 0 cuts through the end of the year. I think there's enough evidence for the Fed to rationalize starting cutting rates, between the sort of backtracking GDP growth and inflation, marginally, but shrinking. We're not below the 3% threshold, at least in the CPI number yet. But I don't think we'll need to get below that. I know they keep saying their target is 2%. I don't know that we'll need to get below 3% for them to start cutting rates. So yeah, I think two 25 basis point rate cuts for the end of the year. Do you agree?
I don't know. I still like July as a dark horse surprise cut. It's like
Yeah, it's not off the table.
if you're at the track and you've got like a 19-1 long shot and you're like, yeah, all right, well, we'll play with that. That's sort of where I'm at with the July cut. I think it could come out of nowhere. You've got the labor market is softening a little bit. If the Fed thinks that they have successfully engineered the soft landing, then realistically they would probably start cutting this year. September is probably more realistic than July. I wonder if maybe they take a wait and see though, if they cut in September and then hold off on cutting in December. Like,
Yeah.
if I have to make a call, I say one rate cut. Although if they surprise cut in July, maybe they've got enough room for data to trickle in where they make a second cut in December. But I'm not betting on the July cut. That's a long shot.
Yeah, 10%, as I said now, according to the Fed Watch tool.
Yeah.
But there is now, by the September meeting, there's now a 6.5% chance of 2 rate cuts, which I'd be very surprised at. But it's not.
Yeah, I don't.
It's not a 0% chance.
Yeah, I don't think they come in during any individual meeting and cut by 50 basis points. I think they do one cut.
I think they're saying maybe July and September.
Yeah. Either one gets you there. But
Right.
like a 10% chance, and 10% and 60% in September is
Okay.
My money's still on one, but
Okay. Yeah. All right. Well, we'll see. We'll know the answer by the time we do the
Yep.
next hot sauce punishment episode. Okay. You're number three.
Gold hits all-time highs again this year. So
Yeah.
uh, it ties in with everything that I've been talking about. There's a ton of excess liquidity in the system. Right now, it's going to stocks. Once rates start coming down in July or September, November, December, whenever that actually happens, then you get then you have investors that are more receptive to putting stuff into more rate sensitive assets. That's going to be bonds, it's going to be small caps, it's also going to be gold. Gold also has the added benefit of the sort of fear factor of global conflict, devaluing US dollars. I mean, right now the dollar is incredibly strong. I know relative to the Japanese yen, they're talking about implementing price controls because that's at some like 25-year lows relative to the dollar, or maybe even more extreme than that. I think there's a lot of conditions in place that make gold an attractive fear trade, and especially if and when we get cuts, that definitely benefits the yellow metal.
Yeah. I mean, we had Matt Warder was our guest last week. In case you missed that episode, it was a good talk with him. He's a cyclicals and commodities expert who is the new chief analyst of our Cabot turnaround letter, value investing newsletter. And he was high on gold too, among other things. But I think he shared that sentiment with you. Yeah, that makes a lot of sense. I think we'll especially see. I agree with you. It'll hit new highs, and I think that'll likely happen in the next 3-4 months. I definitely think pre-election, because pre-election angst,
Yeah, I didn't even consider the
especially after last
political.
night, maybe.
Yeah.
And also with two major wars going on too. Who knows if that could influence it, but yeah, I could see it really spiking in the next 3-4 months here.
All
I
right.
can see it
What
getting above what was it? It topped out at like
24?
2430-ish, something like that.
Yeah, somewhere right around there.
I can see it getting well over 2,500 an ounce. So yeah, maybe gold. Maybe now is a good time to buy gold miners. Um, okay, my third and final prediction for the second half of the year. I think I made this prediction at the beginning of this year. I was wrong. Double shots of hot sauce for that, thanks to Madison, our producer. The equal weight index will outpace the S&P 500. S&P 500. Now this is based on us saying that that there will be more rotation, and that S&P won't be all completely carried by Nvidia and the Mag 7 and some other AI stocks. S&P year to date is up, I think, a little over 14%. Let me pull it up right here. Yeah, so the first half of the year, sorry, now over 15%. We're at new highs above 5,500 as
Yeah,
of
that counts for my we'll have 10 new highs, just so you know. I'm just calling it
okay.
right
Yeah,
now.
there's one. It happened while we were sitting on this
If it
podcast.
closes at new all-time highs, that counts, and that'll be the only one I get, right?
Yeah. Meanwhile, the equal weight index, which equally weights the 500 stocks in the S&P, so it takes out the plus 30% weight, like 32% weighting for the Mag 7 right now. Is that right?
Yeah, it should be around 31%, 30.7, I think was the last one I saw
Right.
on Yardini for the Mega Cap 8. So
Right.
if you just look at Mag 7, it'll be probably closer to 30.
Okay. So equal weight index up 4.3% year to date.
Yeah.
Not very good. Flat since the start. I've mentioned this several times before. Flat is up very, very slightly, essentially flat, since the start of 2022. I still feel like, it's why I brought it up towards the beginning, is I think there's going to be some rotation into, at some point, all these unloved other sectors, and 9 of the 11 sectors, major sectors, are below the S&P's, sorry, let me get this right. Price to earnings ratio for the S&P 500 right now is something like think it's just below 20. Um, but 9 of the 11 sectors are below that valuation, have lower price
Yeah.
to earnings ratio than that. It's all in
Those
like the two, was it?
communication services and infotech are the
Yes,
only two,
exactly. And those are, very overvalued, at least by the
34s or
numbers.
whatever.
Right. So, if it's as Mike Santolo has written, he's a growth investor, certainly in the value space. I'm seeing it with the Cabot Value Investor newsletter. You're not making a whole lot of money and haven't made a whole lot of money in the last 2.5 years, unless you invest in, a handful of stocks, AI, Mag 7, like GLP-1, the weight loss drugs, those
Yeah.
have gotten you there. And of course, the stock pickers market, there's exceptions, of course, but you just haven't made a whole lot of money the last 2.5 years by and large, with a few exceptions. And I think that's bound to turn, especially with the bull market still going on. So I know it. I said this at the beginning of the year, and it doesn't look like equal weight is going to outperform the S&P for the year. Again, only up 4% year to date versus 15% for the S&P. I think it'll get closer, and I do think it'll outperform in the second half of the year.
I like that. So intellectually, I like it. I am counterindicating myself on this show. Like my gut says, go buy Russell 2000 and IJR because
Yeah.
surely this will reverse at some point.
Yeah.
I don't know. It's a freight train. I'm just getting out of the way.
Yeah. I mean, it goes a little bit against the trends last longer than anyone thinks
Yeah.
theme. But I just said, I think the market will pull back between now and the election.
Yes. Yeah.
And I think, where do people go during times of uncertainty? They go to utility stocks, which we already saw some strength in utility stocks, at least fairly
Like,
recently.
yeah, I think
And
April was a really good month. I think it was the
yeah,
best performing sector in April, possibly.
right, when
I
the
might
market
have to.
was down.
Yeah.
And then gold miners, as you mentioned, I agree. Maybe some other cyclicals, I think will get some love. In the second half of the year, and again, especially between now and the election. So, um, I'm betting on the equal weight over the S&P. Even though I think the S&P will be up between now and the end of the year, I think it'll be up somewhat marginally.
Mhm.
Equal weight, I could see being up double digits between now and the end of the year.
Yeah. Yeah. It's God. It's such a hard market,
It
right?
is, it's the strangest market.
It,
I've been in the business since 2011. It's the weirdest market I can remember, where it's kind of like the economy, I guess, where I just meant, I said over 50% of Americans think there's a recession going on, and we're not even
yeah.
close to it. Most Americans would be very surprised to know the S&P is currently at all-time highs, um, because that's probably not what they feel in their portfolio. Or at the
That's
very least, it's still recovering. Their portfolios are probably
no,
still recovering from the damage done in 2022 and first half of 2023.
that's a very good point, and I don't think it's something that we've talked about. If you're in a diversified portfolio where you've got, let's say, 30% bonds, maybe you've got 15 or 20% international exposure, that's half your portfolio that has essentially done nothing for the
Mhm.
last 2.5 or 3 years. And then if you're comparing portfolio performance to S&P performance, you're looking at it, you're like, well, I've made 15% in 3 years, but the S&P is up 40% or whatever the
Right,
number
right.
actually is. That I think that's probably part of it. I think that
Yeah.
might be
It
some of
would
the
have to be
psychology of it.
portfolios that are heavy on, you know, Apple, Nvidia, Amazon, all the biggest name stocks that we've been talking about all year. Um, but generally, 401k types,
Yeah,
if it's
exactly.
those are spread out a little bit more than that and aren't concentrated in the big names, sort of like an equal weight portfolio.
So I didn't want to make this part of the prediction, but when I was talking about the M2 money supply, upside target on the S&P would be close to 6,600 for us to be consistent with the 2000 2001 internet bubble. That would be the same ratio. as 20% upside from here. I don't think it hits it this year,
No.
but if we get more of the same, more of what we've had for the last 16 months, those are the levels where you then have to, I think, start worrying about like bubbles bursting. But that would be an aggressive upside target, certainly this year, but even within the next probably 12 months. But
Yeah.
those are that is the level that I'm looking at as being worrisome.
Yeah. Yeah. Well, we're not worrisome now, even at all-time highs. And it's a very fascinating dichotomy of a market right now, or
Yeah.
a enigmatic market. What's the word I'm looking for? Paradoxical market, kind of, you
Paradoxical.
know. But we'll see what the next 6 months brings. And we'll see how right we are in our predictions. It's very hard to predict right now. And, as we always say, Cabot, our crystal balls are in the shop, but it doesn't stop you and I from just boldly making predictions
No.
like this every 6 months. One thing before we go, just programming note, next week, 4th of July, we will be off. Next week, there'll be no episode next week. So we'll be back in 2 weeks. It gives us a chance to sort of hit the refresh button for the second half of the year. We don't take many weeks off. This is like maybe the second we've taken off
Yep.
since we started the podcast. So, but I encourage everyone to go back and look at some of the recent ones, especially the interview with Matt Warder last week. As always, like and subscribe. Anything else to add before we sign off?
Yeah, if you're going into the back catalog, we had a roundtable episode with a number of Cabot analysts just a couple of weeks ago. That's a solid one to check out. So that would be my recommendation. If you miss us and miss hearing our voices, either Matt's episode from last week or the roundtable one from before that are a good place to start.
Yeah. The rest are all rubbish. No. But happy 4th, everyone, and we'll see you again in 2 weeks.